Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, December 20th, 2024. It's 11:26 a.m. Eastern Time. I'm starting the video, so we're 2 hours into the trading day. Wanted to do at least one more video today. This may be the last one. And if there's anything else that stands out, I'll post another update with either screenshots or do another video. But just want to kind of recap. There were a couple questions I answered today. Just give you my thoughts on the market, where we're at, what my plan is for today, which I already laid out, kind of the short-term plan and the longer term. But I'm going to talk a little bit more on the what I call typical swing trader time frame. The typical swing trade I define as a trade typically measured in weeks, anywhere from a few weeks to a few months. Active swing trading can be measured in hours or usually days, no more than a couple weeks, and then you have long-term trend trading. So let's just talk about the sell signals I've been talking about. This is that trend line on QQQ off the August 5th lows right here. Lots of clean reactions, breakdown yesterday, and currently a back test today. This is the daily chart. So this is how we close today. If we close about where we are now, then that's simply a back test. It's simply a breakdown and a back test of the trend line, so it keeps the sell signal intact. If we somehow rally up today and close solidly back above it, then this was a whipsaw, and that is inherently bullish. Whipsaw is a false breakdown. The reason those are inherently bullish is because short sellers pile in, and you shake out some weak-handed longs. Then when the reversal happens, the short sellers will usually cover when they see the breakdown failed. So that when you are short a stock, you're shorting shares you don't own, but to close the position out, you have to buy to cover, which is literally a buying of the shares. You're buying those shares, so that's buying begets more buying. And then you also, the sharks, small blood in the waters, flexible traders like myself, just as comfortable going long or short, will see that, and then they'll pile in and jump in. So you get some new longs that come back in that feel it's safe to get back in the water there. And so that's what tends to happen. So the day is young. There's still plenty to happen today. All I can tell you definitively right now, I always share my thoughts. That's what I do with my little arrows, tell you where I think things are going. There was a good chance for the bounce today, which we've got. Took us back to the bounce targets. And this is what I think will happen. But if it doesn't, then that affects how I go positioned into the weekend and maybe even next week. So a couple questions put to me. One of them was somebody asked about the bearish engulfing candles on QQQ, the potential bearish engulfing. As I said before, yesterday and again today, as long as the body of this candle, the fat part, engulfs the body of that part, it's a bearish engulfing. And while there is no such thing as a 100% effective sell signal, any sell signal is prone to fail. These are pretty good ones, especially when you recognize them at the right point in time. In other words, we have divergences, extreme sentiment, poor market internals deteriorating lately. So there's enough evidence out there to say this could be a topping stick, because that's what a bearish engulfing candle is. Just like a bullish engulfing comes at the end of a prolonged downtrend, that's where you want to look for it, and all the other traits. I like to see divergence and big intraday reversal. So again, right now it's still a potential bearish engulfing. If we close the day below the body of that other candle, it will be a bearish engulfing candle. And the strategy, as I said, is simply you can take a short position and you put a stop above the recent highs, and that would give you, let's just say from where we're at right now, we're only talking about 3.5%, not even. Again, for the potential to make well into the double digits on the downside, if it proves to be a topping stick. Again, if it's recognized on the weekly, if it plays out as such. So that's it. Either take it, don't take it. Now, to expand on that, somebody asked, hey, is that still a sell signal if we close back above the trend line? Remember, irrespective of whether we close above the trend line, this is a whole different type of sell signal. It's a candlestick reversal pattern. When I go long or short, I typically will go long on a buy signal or short on a sell signal, and that is on a breakout of a bullish or bearish technical chart pattern, usually defined by either an uptrend line in the case of a short trade, or in a bullish trade it would be a downtrend line like a wedge, or some other type of pattern, or a horizontal resistance level I quite often will go long on, or a break above moving averages, things like that. Okay, so that's all based on price levels and trend lines. This is a whole different way to trade. This is trading on candlestick patterns, and a bearish engulfing candle is a candlestick reversal pattern. It's going to be even better if you get it this week. The odds are going to increase if you start getting some red sticks afterwards, some follow through. I really like to see that in the coming days to weeks, especially the bottom of the candle get taken out. So the bottom line is it's not an all-in aggressive short. These aren't like screaming sell signals. Just because I've been talking about those trend lines, so the August 5th trend lines, for quite some time, there's a lot of other things out there. So this isn't the be all end all. And, I think the best thing, especially if you're looking to position for a long-term swing trade, it's more of a scale in time approach. You get a check mark this week with the bearish engulfing, that's one check mark. If you get a close below the trend line, and this is what I answered in my reply, that's even better. However, if we solidly close back above the trend line today, let me go back to the daily chart, then that it certainly chips away at the bearish case. So what that means to you may be different from me. At the very least, in my opinion, would not be going aggressively short. And if you want to wait and see what happens next week, that's not a bad thing either, especially, again, if we close solidly back above the trend line there. Hopefully that all makes sense. Let me cover a few more things. So right now, again, on the daily time frame, we're currently back testing that. A lot's going to happen between now and before the close. We're either going to build on this and close higher today, or we could go higher and then reverse. Again, how we close today, as far as the trend line goes, this is a trend line here. It's long enough to use it on the daily time frame. So all that matters today in regards to this trend line is how we close the day right now. All right. Same thing with the weekly candle. That's going to matter how we close today, because today is Friday and that closes the week, which finalizes that weekly candle that I just was showing you a minute ago. So that's that. Let's look at a few other things. Let's look at the S&P 500. That is below, again, the October 5th trend line, or I'm sorry, the August 5th trend line didn't have as many reactions. Even though I put it here, I'm not as crazy about it. This is the best defined trend line we have, and SPY recently had the most clean, distinct reactions, 3 separate groups of reactions, sell signal there. But really good price support, as I mentioned there, about 584.50 or so. As I've covered recently, was the previous highs here, breakout to new all-time highs, successful backtest at that level, and this is simply another successful backtest. So again, I don't know if we'll get resolution on this today. So far, it's a successful backtest, but we're really on it. Like, today's candle, we hit it. It's a daily candle, slight undercut intraday, but if we close down below it, solidly below it, then it means this breakout has failed. If we start to rally from here into next week, especially if this trend line is taken out, then that was another, call that a second successful backtest of that breakout to new highs. So kind of that's the takeaway, guys, is let's see where we're at. I highlighted an objective level to game of balance today. If you're an active trader, it's good for at least a couple percentage points, whatever it was, and we'll see where the day closes. As far as the VIX goes, it should go without saying, but those objective levels to re-enter the shorts if you played a bounce. Same thing if you sold. Remember the VIX I showed you in the previous video in pre-market. I have my pre-market trades turned off now. We hit that target perfectly. Very, very good resistance level. Pulled back, and here's that big old gap right there that defined this whole trading range here. Take it across. You have a reaction high. Again, these were the targets on the way up, all hit, including this one. And the way it works, they were resistance levels on the way up, or potential resistance levels. They were, the VIX kind of exploded that day, so we blasted on through the first few of them. But they're still valid, and this one's a pretty decent one because, again, that's a big, pretty technically significant gap. And so we're right now splitting the crosshairs between that 49 level, that reaction high there, and that 47.83-ish level. And so I view that as an objective area to add back for anybody that booked profits and or turn around or shorted the VIX in expectation of this bounce. Again, oversold, everything I covered before, and that makes sense. Well, now stops are going to be dependent on, again, your targets, your time frame, how you're looking at the market. The entry on this VIX trade, if you just look, this was the entry. It was shared as a setup before it even broke out. Our breakout was right here. So we're still very, very profitable to the tune of about 17%, even with this turnaround, the give back right there today. So stops are going to be commensurate with where, if and where you took it. Some people like to set stops at, once they get profitable, they like to move stops to their entry point to assure no loss, at least a break even on the trade. Some like to ratchet stops up along the way, let it run. And some like to keep the original, they went in there and they had a stop down below here because they were targeting up here. They might keep that stop. So again, and most folks like myself, I scale in, scale out of position. So there's often not any one single point. You have to look at your average entry point. I did want to update natural gas. It's, the market's only one thing. I always say that. The stock market, as often as I'll cover it, it's just one single trading vehicle. My opinion, you should never have all your money in one thing. I like to spread bets, spread around different stocks, sectors, asset classes. And this is UNG. Remember, UNG, I told you, although I had the purple box shaded like this, the recent highs were here, and that's what I've been highlighting on the futures. Remember, over time, this will drift a little bit away from the actual price of when you look at chart natural gas prices or go back and look at the futures because of the fees and expenses this ETF has. But we're pushing that, and we're poised to break out. Let me show you the futures. That's again the chart you should put the most emphasis on, I believe. And this is that 60-minute I've been showing you, but I also have to jump out to the 6-month, 2-hour candlestick chart to show you. This is, again, you've got a couple reactions there. And, over time, there's a lot of volatility and certain things that you get as the futures roll. When you look even at the continuous contract, the price levels move around. There's a lot of variance in month to month on the contracts in natural gas. Due to its volatile price history, and again with the futures we'll price in. But again, you can see it's a pretty good level, and we're pushing it now. We do not have negative divergence, although I take that back, guys. We actually have it if you look back here from that previous high. So hopefully we had some divergence building the other day on the shorter term time frame. So bottom line, if the breakout I put first and foremost, it's a level I've been looking to break out. Now we could pop it and go down if we do, and you start to move lower, you're going to have a divergent high. It could set, especially if the breakout fails. Again, it's not a hard level. You can see a few little pops above it there. It's kind of a rough level. I have it at 3.644. I have us just trying to pop above it. And remember, so when I look at this and I say, okay, I can make a bearish case to short it here. We're at resistance, negative divergence, and there it is. So if you want to do that, short it, and it may go down. But I've been making for months now the longer term bullish case based on the weekly chart. We're not looking at it here. I didn't have it queued up for this video, but I've covered it many times. So therefore, that's why I tend to, give it the benefit of the doubt here and see if we can power on through those divergences, break out, and hit my $5 target. So remember, we're only at 365 right now. That's been my longer term swing target, $5. It's north of this chart, only caps out here around 4. It's up higher because, again, it's based off the weekly chart, not these intraday charts. So that's your update on natural gas. Let's see if we can power on through there. We probably won't get clear visibility on if it's going to break out until next week would be my guess. Wheat, corn, still waiting for the breakouts. I've covered that recently. Wheat has some really, really nice, super duper, I'll call it long-term support on the weekly chart. Goes back for decades, and we're not too far from it. So, like I said, I'd love to see it get there. It may or may not get there. You have these downtrend lines. If you pop, you're going to get another rally before you do, and maybe we get there 6 months from now. So either way, I think the downside's minimum on wheat. And we just need to see it break out and start to run. This is just the ETN right here, WEAT. I'm going to take that trend line down a little bit. It does a good job, not a perfect job, of tracking the futures. Corn broke out, and that's, took out this downtrend line, long-term downtrend line, but it's not really running yet. But if corn can break above this level, it'll pull wheat along with it most likely. I always kind of refer to these. I'm not an expert in ag commodities, but I trade them a lot, and I know that they move together, and they're also, like I often refer to, as like competitive or alternative food sources. You go to your favorite Mexican restaurant, where they ask you want the corn or the wheat tortillas. You can make them with either. It's cereals made out of corn or wheat. So the price gets too high on one, people can shift to the other. Just like coal and natural gas. There's a lot of power plants out there that run on fossil fuels can switch to either, depending on what the price is, and that's why all those fossil fuel, oil, natural gas, even coal, kind of play off each other. If one gets too expensive, people use the other one. All right, so that's it. Let me see what else I have for you. Yeah, no, that's it. Let's just keep it here. Let's keep it simple. Let's see how the market closes today, and we'll go from there. I'll one way or other, I'll give you an update either shortly before the close or after the close today. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart.